If you're watching this video, it's probably because you either bought into Beyond Meat during its October rally and you're wondering whether that rally has already run its course, or maybe you've been waiting on the sidelines, watching all the volatility, trying to decide what to make of it. Hang in. We're going to break it all down. By the end of this video, you'll see exactly where Beyond Meat stands and what the chart and fundamentals are really telling us. Today we're talking about Beyond Meat, its long-term decline, the recent rally, and that sharp correction that caught a lot of traders off guard. We'll look at the chart, the fundamentals, and come to a clear picture of what's really happening beneath the surface. Here at Tracking Stocks, we follow proven trading systems, the kind developed by William O'Neill, Stan Weinstein, and Mark Minervini. We don't chase hype or headlines. We take only those trades confirmed by sound technical patterns and strong fundamentals, the kind of setups that lead to real, sustainable gains. At the end of this video, I'll show you one powerful tool you can use to analyze Beyond Meat, or any stock, to confirm everything you see in the price action and fundamentals. Trust me, checking this one piece of data can mean the difference between entering a fantastic trade or getting trapped in a mediocre stock, or worse, a loser. Stay tuned till the end. You'll know exactly what it is. Let's start with the chart. Beyond Meat has been in a prolonged downtrend since January 2021, when it hit an all-time high of $221 per share. From that point forward, the stock has been locked in a steady pattern of lower highs and lower lows, showing persistent selling pressure and a complete lack of institutional support. Even when we zoom into just the last 18 months, the story doesn't change. The trend is still clearly downward, and Beyond Meat keeps carving out new lows, with no signs of stabilization or accumulation anywhere on the chart. Most recently, on October 16th, the stock hit a new intraday low of 50 cents, its weakest level on record. That breakdown marked the absolute bottom of this long decline, and set the stage for what came next. On October 20th, we began to see volume expand, a signal that something was brewing beneath the surface. Then, on October 21st, Beyond Meat announced its distribution partnership with Walmart, and that's when everything went vertical. Volume exploded to over 2 billion shares traded that day, and price action followed. The stock closed at $3.62, after reaching an intraday high near $3.86. The following day, October 22nd, volatility went off the charts. Volume climbed even higher to 2.2 billion shares, and the stock surged all the way to an intraday high of $7.69. But by the closing bell, it had dropped back down to $3.58, slightly below the prior day's close. That kind of wide intraday range, where a stock makes a huge move up but finishes near the bottom of its daily range, is a very bearish signal. It usually points to large-scale institutional distribution, as big players use the retail buying frenzy to unload shares into strength. Since then, the volume has contracted sharply. We're now seeing around 100 to 150 million shares per day, which sounds heavy, but it's a fraction of what we saw during that 3-day surge. And to put that into perspective, before the October run-up, Beyond Meat typically traded only 3 to 5 million shares per day. So while volume is still higher than it used to be, it's nowhere near the 2 billion plus peaks of October 20th through 22nd. And that tells you the excitement has cooled, the momentum has faded, and conviction has drained out of the chart. Beyond Meat also faces heavy overhead supply between roughly $4 and $11, where past buyers are still waiting to sell once they break even. This overhead supply will be a major hurdle for the stock to overcome if it ever attempts another rally. Each push higher is likely to be met with waves of selling from trapped investors looking to exit. At Tracking Stocks, we look for the opposite setup. Stocks breaking out of consolidation areas on high volume, moving into new price highs after clear prior uptrends, and with little or no overhead supply to weigh them down. Those are the charts that tell us the big institutions are stepping in, and that demand is overpowering supply. In Stan Weinstein's terms, Beyond Meat remains deep in a stage 4 decline, and it's not yet clear whether it's even beginning to form a stage 1 base or consolidation. Until we see a clean base breakout on expanding volume, there's no technical reason to get excited here. When we shift from the chart to the financials, the story doesn't get any stronger. Beyond Meat's total revenue has been in steady decline since 2021, when it peaked around $464 million. This year, the company is on pace to bring in just over $300 million, marking another year of contraction, not growth. At Tracking Stocks, we want to see consistent revenue expansion that confirms earnings growth is driven by an expanding top line and is sustainable. Beyond Meat is showing the opposite: shrinking sales, negative margins, and no sign of a turnaround. The company has reported negative operating income for 5 consecutive years, meaning it hasn't generated profit from its core business in half a decade. We're looking for stocks with positive operating income that's growing and accelerating over time, not companies losing money year after year. Cash flow tells a similar story. Beyond Meat's cash flow from operations has been consistently negative, and its once strong cash position has been draining quickly. Back in 2021, the company held roughly $750 million in cash. Today, that number has fallen to about $100 million, burned through funding unprofitable operations. When you put it all together, declining sales, negative income, and eroding cash reserves, you get a company that's not expanding, not profitable, and not positioned to support any sustained price recovery. And that's exactly why, when we analyze Beyond Meat from both a technical and fundamental standpoint, the evidence lines up perfectly. This is not the type of setup we want to see building under the surface of a strong stock. The October rally didn't happen in a vacuum. On October 21st, Beyond Meat announced it was expanding distribution through Walmart, adding its products to over 2,000 stores across North America. That headline alone ignited a massive retail trading frenzy, fueled by social media buzz, short covering, and hope for a turnaround. For a few days, Beyond Meat traded like a meme stock, rocketing more than 400% in under a week before giving most of it back. But the excitement didn't last. Analysts pointed out that while the Walmart news was positive, it did nothing to fix the underlying issues: declining sales, negative margins, and high cash burn. As the hype faded, selling pressure returned, and the stock fell right back toward its lows. In short, a headline-driven rally without fundamental backing, the kind that looks explosive on a chart, but can't hold once reality sets in. Remember earlier in the video when I said there was one powerful tool that can confirm everything you see in the chart and fundamentals? This is it: the 13F filings. If you're new to them, 13F filings are quarterly reports that large institutional investors must submit to the SEC, showing exactly which stocks they're buying and selling. It's one of the few transparent ways to track where the smart money is going. In the Can Slim model, this ties directly into the I for institutional sponsorship. The idea is simple. You want to trade in the same direction as the big funds, not against them. When institutional ownership is rising quarter after quarter, it shows confidence and support, the kind of steady buying that can fuel powerful uptrends. But when that ownership is falling, it usually confirms what the chart already shows: distribution, not accumulation. And that's exactly what we're seeing with Beyond Meat. Institutional ownership peaked back in Q4 of 2020, when more than 500 institutions held shares. Today, that number has dropped to just over 200, and it's been declining quarter after quarter since Q4 of 2023. The 13F data works like an X-ray. It lets us see beneath the surface of the chart, beyond price and volume, to reveal what's really happening behind the scenes. And when you look through that lens, the diagnosis isn't good. The big money has been quietly exiting this stock for years, and there's no indication they're coming back anytime soon.